Hi, I'm Michael Yardney and I was recently rung by a journalist from one of the major daily news sites asking me for my predictions for the property hotspots for 2016. Apparently an article he wrote 2 years ago predicting the hotspots for the coming year was one of the most popular on their website, and now coming to the tail end of the year it seemed opportune to write one for 2016, and he asked me for an update on my opinion. Now, while I love giving my opinions to the media, I hate being asked for hotspots because that's not how I work. Rather than looking for the next hotspot or the next big growth area, which a few months later will be proven wrong, I prefer to use a strategic approach to finding investments that will outperform the averages over the medium to long term. Interestingly, before I replied to the journalist, I had a look at the original article online, and I was fascinated to see some of the predictions others had made and how those suburbs, the so-called next hotspots, had actually performed over the last year or two. Interesting is a good choice of word, in fact a generous choice of word, for some of how those suburbs have underperformed. Many of the outer suburbs and the regional towns just didn't gain the traction that the hotspotters were hoping for. Just like many of the mining town hotspots that were the flavour of the month a few years ago have left the landscape littered with investors who lost money. Places like Port Hedland and Moranbah and Mandurah and Cairns and Gladstone. So what will drive our property markets next year? The impact of the wild volatility of the Australian dollar, overseas economic issues, a flood of foreign buyers, APRA tightening the screws on investor lending, and the long period of low and stable interest rates. Look, they may all appear obvious in the rearview mirror, but what lies ahead is inherently difficult to judge. Perhaps impossible. However, likely factors to affect our property markets over the next year include the Australian economy, and that's slowing. How this pans out and how the RBA responds with interest rates will clearly impact our property markets. The second factor is APRA's regulations targeting homeowners and investors. That's going to slow down the investors and home buyers who are on the margin of getting serviceability for loans. And investors with large property portfolios who are rent reliant are also going to find it harder to get finance. Population growth is going to continue, albeit at a lower rate. And they're going to head for our four big capital cities, but particularly Melbourne and Sydney, where growth in service industries is creating more jobs. Interest rates are likely to remain low and drop further if our economy falters. Next year, business confidence should continue to rise as we seem to have a stable government at both the federal and the state levels. And consumer confidence has been rising since Malcolm Turnbull was elected as Prime Minister, but this remains fickle. And another factor to consider for next year is jobs growth and steady unemployment, and this is going to lead to extra consumer confidence. The combination of these factors means that 2016 won't be as good for housing markets as growth was in 2015, but that doesn't mean we're going to have a property crash. Nationwide price falls are unlikely before the Reserve Bank raises interest rates, which probably won't be until 2017. However, decreasing affordability, changing sentiment and an oversupply in several sectors such as the CBD and off-the-plan markets is going to create a volatile mix that will fragment and slow our property markets, moving some from sellers' markets to buyers' markets. Now, this is already evident with falling auction clearance rate, particularly in the Sydney property market. And next year, as always, demographics are going to drive our property markets. Let me explain. As Australia's economy bumbles along, I can see little wages growth over the next year or two, but I do see interest rates rising, maybe sometime in 2017, and both these factors will affect some suburbs more than others. What I mean by this is rising interest rates are likely to affect suburbs that are more interest rate sensitive, like blue-collar areas, regional locations and first buyer locations. On the other hand, property values are likely to increase in more affluent, gentrifying, middle-ring suburbs in our major capital cities, where the locals' income is less dependent on the CPI increase in wages, and they're not going to be affected by rising interest rates as much. It won't affect their disposable income as much. So my topic for suburbs that will outperform in 2016 will be where people have high disposable incomes and are able to and prepared to pay a premium to live there because of the amenities in the area. Property price growth in Sydney is likely to slow down, maybe to around 5%, and Melbourne prices should grow a little bit more than that, maybe around 7% over 2016. Prices will fall a little in Perth and Darwin as the mining boom continues to unwind, while Hobart and Adelaide are likely to see continued moderate growth. But Brisbane's property market should start to pick up further as it plays catch up, rising about 7% over the year. Now, I can't really see a reason for regional or mining town real estate to have much capital growth. There's no influx of new people into these regions and little to strengthen their economies, and investors are no longer buying up big in these areas. Now, I think 2016 is going to be a really good year to clean up your house. While I still see some good opportunities in selected property markets, I recognise that strategic property selection is going to be more critical as capital growth won't be as strong next year. It's not going to cover up your mistakes. I also see 2016 as a window of opportunity for those with underperforming properties in their portfolio to divest themselves of their lemons, because the odds are they're going to continue to disappoint. Now, the best way you can uncover an underperforming asset before it eats too much of your bottom line is to annually review your portfolio and ask yourself some hard questions. I'd be asking things like, is this property likely to perform like I expected? Is this property outperforming the market? If this property were on the market again today, would I buy it again? Is there anything I could do to improve my property so it generates me a more attractive return? And lastly, I'd ask, is this property likely to outperform the market averages over the next decade or more? Now, sure, property is a long-term investment, but occasionally the right thing to do is cut your losses and sell up because you can buy a better property. Don't wait for your local market to get better, because the gap between the value of the property that you currently own, if it's underperforming, and top performers will only get wider. However, if your property is tenanted, maybe you should consider selling it at or near the end of the lease term so it appeals to a wider range of owner-occupiers as well as investors. 2016 is going to be an interesting year in property, and if you'd like to take advantages of the opportunities and not get caught in the minefields, why not get the independent team at Metropole on your side to help you formulate a property strategy if you haven't got one, to help you assess the performance of your current investment portfolios, and to help you in your wealth creation journey. So give us a call at Metropole, and we'd look forward to being part of your wealth creation journey.